Hey, what's going on, everybody? You ever wonder how it is that bankers seem to always know about lending and they can seem to make split-second decisions and recommendations on things? Well, that's because banks teach bankers about lending. They teach them about credit, and they teach them a very quick, fast, and easy way to let somebody know whether or not they're going to get approved or what they should do. Now, if only you knew a banker, like someone who's been doing that a long time, like a veteran banker. Obviously, that's me. So today, I'm going to teach you guys about lending the same way that banks teach bankers. It's real simple, it's real easy, and by the time we're done, you'll be able to walk in there and keep up with all those guys like you just clocking into another day in the office. So bankers are taught about credit in a very simplistic, easy way. Credit and lending is broken down into 3 C's. The 3 C's of credit. You can call them keys, whatever you want to do to impress your friends. But there's 3 C's of credit that you need to understand. There's credit, there's capacity, and there's collateral. Now, I know that on their own, those words can just seem like arbitrary things that are made up. But as usual with everything, I'm gonna break it down for you. I'm gonna tell you exactly what it means in plain English so that you can go back and you can tell your family, you can tell your friends, and you can know what these things are so you're prepared when you go into the bank, you can get whatever it is that you need. If you're not subscribed yet, now is a great time to subscribe. You'll find that I break things down into really easy, understandable ways. And if you're not familiar with credit or you need a loan, whether it's a student loan, if it's one for a car, if you're trying to buy a house, you need a personal loan, any type of way you want to borrow some money that is yours, you want to watch this video all the way through because this is definitely going to be one of the most important or best videos you've ever seen when it comes to credit. So talking about those 3 C's, credit, capacity, collateral, I'm going to keep saying them because it's important that you know what they are. And I know some of you out there like, wait a minute, how can the 3 C's of credit have one of the C's be credit? Well, banks make this stuff easy for a reason. When you think credit, you think the 3 C's of credit, it just sticks. It's easy to understand. So what's that first C? Credit. This is your credit report. All 3 of them actually, and not always. Depending upon the bank, sometimes they use TransUnion, Equifax, and Experian. Sometimes they use 2. Sometimes they use 1. It depends what you want, how much money you need, and what bank you're going to. But credit, to make it easy, is a history of who you owed money to and who you paid. Basically, I need to know if you're going to pay me this money back. Now, if you haven't paid people back in the past, i.e. you have bad credit, I'm not loaning you nothing because you didn't pay the last guy back. Now, if you've been paying everybody back on time, you've got good payment history, sure, I'll let you borrow some money. You pay everybody else back, means you're going to pay me back too. So the second C, capacity. Seems like a really trumped up word. It doesn't seem to make any sense. Capacity is how much money you make. It's the long and short of it. You make more money, you have more capacity. Now, when you hear capacity, there's another term that gets thrown in there called debt to income ratio, or DTI. All that means is who else you owe money to. That's it. So they look at how much money you make, who else you owe money to, and how much money is left. If you're gonna borrow some money from me, I gotta make sure you can pay it back. That's capacity. As far as debt to income, who else you owe money to? Now, when you start looking at larger loans like mortgages, they're gonna say, all right, who else do you owe money to? So if you make $2,000 a month, but you have $2,000 worth of bills, you have no money left over. So I'm not gonna loan you any money because you can't pay me the money that you're trying to borrow. That's capacity. Is do you have the capacity to pay me back this money that you try to borrow? So that's all it is, all right? So the last one is collateral. What are you using the money for? I need to know what you're buying because if you don't pay me back, I'm gonna take that item. And it's real simple. You want money for a house? The collateral is the house. You want money for a car? The car is the collateral. Well, some of you are probably asking, what if I don't have any collateral? Your interest rate's gonna go up. I'm gonna charge you more money because there's nothing I can take if you don't pay me. So now we got the 3 C's. There's credit. Who have you paid back in the past? Do you have a history of paying people back? Capacity. Do you have the money or capacity to pay me back what you about to borrow? And collateral. What are you using the money for? If you don't pay me, is it something I can take to get my money back? So with those 3 C's, a bank can decide whether or not they're going to loan you some money and how much interest to charge you. The reason the interest rate is going to vary is because the more risk the bank is going to take on, the more money they're going to charge you in interest. So you're probably wondering how those 3 C's factor in the risk. Well, let's look at them. You've got the 3 C's. Remember what they are? There's credit. Have you paid people back in the past? Do you have a history of paying people back? If you haven't paid people back, that's more risk to me. period. If you don't have any history of paying people back, that's more risk to me because I don't know whether or not. So with those 3 C's, you can determine, the bank can determine how much your interest rate is going to be. You probably wonder, well, how does those 3 C's calculate into my interest rate? Well, that's pretty simple too. Any one of those C's is going to help you determine how much risk you are. The more risk you are, the more I'm going to charge you in interest. You got bad credit, you don't have history of paying people back, there's more risk in me losing my money. I'm going to charge you more money. Oh, your capacity, you don't make a lot of money or you owe a bunch of people a lot of money, there's a risk that you may not pay me. I'm going to charge you more interest. Well, what about collateral? What are you using to buy this? Is it some piece of junk or is it something that's worth a bunch of money? The more money that item is worth, usually the less risk there is to me. You want to buy something cheap? I'm going to charge you more interest. Story time. I was going over these same concepts with one of my customers when I was working in the branches. And I had someone ask me, why is it that poor people get charged more in interest? And I had to stop and I thought about it. I said, well, it's not that poor people get charged more than interest. Because quite frankly, that seems kind of backwards. You think the people who have less money will pay less in interest because they have less money. Meanwhile, rich people usually have lower interest rates, but they have more money so they could afford to pay more. When you look at it from that sense, it doesn't make any sense. It's not that poor people get charged more. It's that poor people are usually more risky. Let's look at those same 3 C's. Typically, not always, poor people don't have the best credit reports. They don't. Typically, when it comes to capacity, poor people don't make a lot of money, hence why they're poor. So they don't have as much capacity. Typically, when we're looking at the collateral, poor people want cheaper things. They're not buying expensive houses. They're buying cheap little homes or little hoopty cars. So because on all 3 fronts, these things are lower or, not going to score as high, there's more risk to the bank. So the bank has to charge more interest to offset that risk. And in case you didn't know, or you're not aware, anytime you borrow anything from a bank, you're always paying more interest up front, period. If you're a homeowner and you've looked at an amortization table, you probably know about this. I'll go over that in another video. But the long and short of it is anytime you borrow from a bank, you pay an interest up front. They want their money first and foremost. So if you borrow $1,000 and the interest was like 100, trust and believe that interest is going to be on toward the first couple payments. Not as to say you won't be paying down any of that principal 1,000, but they're getting their interest up front because they want to make sure they make their money off of you. So a couple of months down the line or whatever, if you don't pay or things go sideways, that initial amount that they loaned you, they can still go after you for it because you haven't really chipped into that. All you've been paying is interest. So that was today's video, the 3 C's of credit: credit, capacity, and collateral. It sounds funny to say the 3 C's of credit and then say credit is the first one. But that's things that you need to know. Again, I'm a veteran banker, I'm a veteran and a banker. So I'm gonna go out of my way and I'm gonna do what I can to educate people about finance. This is one of those things that someone asks me, hey, I'm trying to get a house. And someone else asked me about a car and lending and credit and credit cards. It's like, y'all need to understand the fundamentals of lending, period. When I first got into banking, that was one of the first classes they taught me. Mind change. It was life altering because now I get it. Anytime I want to borrow money, you just got to look at one of them 3 things. If you're thinking about going to get a loan and you want like a cash loan, that's why the interest is so high. There's no collateral. Let's say you want to rebuild your credit and those prepaid credit cards, the interest rates are sky high. Number 1, there's no collateral. They can't go after the stuff you bought with the car. Number 2, your credit report's bad. You got a history of not paying people back. So those 3 things help you understand like why interest rates for stuff that you want is so high. When you look at something like a house, you got to have pretty good credit for it. They even take okay credit because the collateral is so solid. If you go sideways on the loan, I'm going to take the house. Like, that's it. And as far as capacity, that's when that debt to income, they want to make sure like, hey, do you make enough money to pay for this house? Because if not, we going to take the house. So that was today's video. The 3 C's of credit, understanding lending, the fundamentals. Again, we're early on in the channel. I'm going to be here a long time. So y'all can get comfy. Y'all can get used to seeing my face. Background might change, depending upon where life takes me. But I'm going to be here for a while. And I'm going to do everything I can to help as many people as I can when it comes to finance. When I was working in the branches, like at a retail banking center, helped as many people as I could. I looked at every customer like they were somebody's father, mother, brother, sister, because they are. And I thought if it was my mom, my dad, my sister, my brother, how would I want them treated? And that's how I treated people. And somebody told me I could help more people if I put videos on YouTube. So that's what I'm doing, putting videos on YouTube. Hopefully this stuff is, as straightforward and as clear as I can make it, so you get it, you understand it, and you can arm yourself to have a stronger financial future. Anyway, I'm Larry. If the video was good, give me a thumbs up. If you enjoy the content, subscribe. Every Sunday, I'm going to go over financial terms, something that sounds like jargon, gross domestic product, recession, bear market, things like that, and break it down into plain, simple English in the only way I know how. So that anybody, whether it's a kid at the dinner table or if it's grandma, or even if it was someone, whether it was grandma who immigrated from a South American country or as a kid you brought over here from Eastern Bloc Europe, if you were born in America, if you don't have a college degree, whatever, I'm going to talk to you in plain English so it all makes sense. Today's video, the 3 C's of credit. Those are 3 key things that you got to know. You have to understand them. You got questions, comments, concerns, leave them down in the comments below. I don't have very many comments, so odds are I'll get back to everybody individually. If it's years later from this and there's a bunch of comments, I'll do the best I can to break things down as clear as possible. If I need a follow-up video, we'll have a follow-up video. But other than that, I'm Larry. I'm your banker. I'll see y'all later.